Welcome to The Exchange with KB with your host, Kirill Bensonoff. Kirill talks to innovators and business leaders who share interesting stories of their success, overcoming challenges, and actionable advice you can learn from. Visit KirillBensonoff.com and sign up for updates. Joining Kirill today is Dave Friedman, co-founder of Knox Financial, which is changing the way homeowners build wealth by making it easy to turn a home into an income property. KB and Dave talk about the real estate space, technologies that are disrupting the space, and how these technologies remove transactional frictions and unlock capital. Now, here's your host, KB.
All right, everybody. We're broadcasting today from my very own studio at the Lifetime Fitness. And David, welcome to the show.
Thank you. It's great to be here.
Awesome, man. Thanks for coming on. I'd love to listen and hear a little bit about your background. Can you tell us a little bit about yourself?
Sure, absolutely. I grew up in New York, moved to Boston for college, and I've never left. In my early 20s, I founded a company known as Boston Logic, and through Boston Logic, it's actually now been rebranded under the name Propertybase. We sold Boston Logic to a pretty big private equity firm. Boston Logic makes software for the real estate brokerage world and now owns several pieces of software for that vertical. So I've spent a lot of time in real estate tech. After moving on from that company, I took a little bit of time off, and then I've last year launched Knox, which makes it incredibly easy to turn a home that you're moving out of into an income property. And if you already own income property, we made it incredibly easy to own income property. Our goal is to make being a property investor as simple as owning a share of Apple or Microsoft.
Yeah, this is extremely interesting because there's so many companies that I follow now that are kind of combining various ways, whether it's real estate, stocks, bonds, or what have you. I kind of call it alternative investing, just combining different asset classes, giving people opportunities that they didn't have before, unlocking equity that people didn't use before in their home. So I'm really interested in learning more about the product. I did want to ask about Boston Logic a little bit, or Propertybase. How did you kind of stumble onto that idea? Tell us what it did and how you kind of came up with it.
Yeah, that's a great question. It's kind of your classic entrepreneurial story. A buddy of mine and I were launching a very different company, a guy named Matt Weiss. And Matt and I were looking for a way to sort of fund the development of that other company, a product that never really got off the ground. So we took on some consulting work in the real estate brokerage world. This is back in 2004. And we were introduced to a vertical that's rather behind the technology adoption curve. And in seeing that, we saw an opportunity, and one thing led to another. We started building software products a few years later. And a decade later, we had a real growing and successful concern. So in some ways, the vertical found us, or we found the need and decided to build a solution for it.
Awesome. And the sort of the underdeveloped vertical was the real estate vertical. Am I correct?
Yeah. Our clients are the folks who help you buy, sell, or rent a home. So real estate brokerages around the country and these days around the world.
So was it just kind of at the time, and maybe I should kind of make it a double question, at the time and today as well, do you feel that the real estate vertical is still lagging behind as far as technological innovation goes?
Absolutely. It's a really interesting space. And we could spend an entire episode of this podcast or two talking about this topic alone. There have been a few notable companies who've come in and applied technology to really change how they operate, change the margins of the business. The average brokerage is definitely still behind the technology curve. If you walk into the run-of-the-mill brokerage these days, the technology they're employing to do their business, it's certainly more than it was 10 or 20 years ago, but it's still not the same amount of technology you'd expect in any other business vertical. And then there have been some interesting companies that have really leapfrogged the industry and had some amazing results. The best example is Redfin. Redfin's gross margin on a transaction is enormous. The way they're using data is incredibly impressive. They're very nimble. There are opportunities when you realize that the industry is behind. The way we looked at it at Boston Logic was, hey, we can help this industry catch up. And other people say, hey, we're going to come in and sort of try to go over the top. And that's what folks like Redfin have done.
For sure, because real estate is a huge asset class. I mean, it's $1 trillion+ asset class. And I think I'm actually, Redfin's an interesting company. I've been following them for quite a while. And initially, it looked like they had some issues, some growing pains maybe, or issues scaling, and because they do charge the consumer less, right? Am I correct in that? And they make their money by kind of making the process more seamless with technology. Am I right in that?
That's for sure. Redfin has a lot of tweaks or differences between their revenue model and your normal brokerage. The outcome is the same. You want to buy it or sell a home, you could do it with a traditional brokerage, or you could do it with Redfin. Redfin in certain cases will save you money. In other cases, they're making more money because they're charging the same rate, but their agents are on a salary, for example. Mm-hmm. So the average Redfin agent does many more transactions per year than the average agent in another brokerage, and they're paid according to different standards. A realtor at a non-Redfin brokerage is usually on no base salary whatsoever, 100% commission, and if they sell, they make money. If they don't, they don't. A Redfin agent gets paid more based on how positive their reviews are from their customers. So incredibly different.
So they flipped the old model on its head, it seems like.
Yeah, another really interesting conversation I had with the CEO of Redfin once, and this is a really big tangent here, but he talked about what in the industry calls sign calls. So, you have a sign outside the house that says it's for sale. Almost always the phone number on that sign is the real estate agent's phone number. Redfin was tracking these phone numbers. They were tracking how often the calls got answered. And real estate agents are often busy. They're showing homes, they're closing deals, they're busy. And Redfin has a call center. So they said, hey, why don't we redirect these phone numbers to the call center and see what happens? And Redfin has amazing data, so they could track this. First of all, of course, their answer rate went to 100% during business hours. And they tracked those people, and the conversion rate from call to closed deal went through the roof. And they said, forget it. This is a company policy. We're making all of our yard signs dial our call center. So Redfin can do things like that. And traditional brokerages are, not even close to being able to do that.
Absolutely. I mean, that's seeming like a simple change that obviously maybe through their data expertise and technology, they're able to kind of uncover, but the other people haven't thought about in a long time. And also, right, because it sounds like because the agents are on a salary versus a typical real estate broker or an agency, and they would be getting paid a commission. So they don't want that call going anywhere else. So they're really trying to get the business all to themselves. And
exactly.
It doesn't always work. Cool. So after you sold Propertybase now, what did you do after? How did you come up with the next idea?
So after I sold it, I stayed on for a while. I continued to be CEO of the new company, which started to acquire other software products in the space. And after about a year and a half, I moved on, and I took some time off, to be honest with you. I had a son. My wife and I took some time off when he was born. It was really wonderful. While I was at Boston Logic, I saw all sorts of opportunities that came, sort of past my desk or through my brain sometimes. And we would chat about them internally with the other people on the senior team, over lunch or over a beer or what have you. And one of them was, we started looking at the data in the space and saying, hey, we understand the data. We understand how to combine data sets to understand who the homeowners are and understand which homes are worth more, how value trends are going, how much a home can rent for. And as we started to think about that, the ideas around Knox started to percolate. And what we began to realize is we could identify which homes were good opportunities for rental income and therefore becoming an investment property. And then the question was, do we think that the homeowners would want to turn them into income property? And then something funny also happened. I had sold a home a few years earlier personally, and I was talking to my realtor who I've done a bunch of transactions with, and he said, that home you moved out of, it's worth another $100,000 now. And I looked at him, and we were having lunch, and I was like, oh my gosh, you're kidding me. It's gone up that much? He goes, yeah. And those people are going to sell it in a year or two and they'll make $200,000. And I just couldn't believe it. Well, sure enough, he was right. And I had thought back to when I sold the home, and I thought about turning it into an income property. And I looked at all of the things you have to do to turn a home you're living in into an income property. You need legal, you need rentals, you need property management, you need a new insurance policy, you might need to refinance. There's a whole laundry list of stuff that has to happen. And I gave up. I sold the place. I said, it's too much work. I'm too busy. I have a day job. And so around that, we built the concept for Knox.
Walk me through the process. I'm a consumer. I own a home here in the Boston area, and I'm thinking about maybe moving soon, right? And so instead of selling a home, I can go to Knox Financial. And how would the process work?
Sure. So most people who come to us are already thinking about not selling their home. They've lived in it for a while. And they go, geez, I live in Jamaica Plain, or I live in Cambridge, or I live in the South End. And property values, while I've been here, have gone up 30%, 50%, 100%. And I don't think that's going to change. I think if I sell this home today, 10 years, I'm going to look back, it's going to be worth another $500,000, and I'm going to kick myself for selling. So that's sort of their reality right now, but they got to move. They're having another kid, they're getting married, they're retiring, you name it. They call us and they say, okay, I'm interested. This is exactly what I want to do. What is the money going to look like? That's the first question everybody comes to us. So we have developed software that allows us to very rapidly analyze a home and tell them, will it be cash flow positive? Will it be break even? Might it actually lose money for a few years until the rent catches up with the expenses? So we can give them that answer. And then we can give them some projected returns, and we can develop a report, and they can look at it at their kitchen table and say, okay, this home is going to make me this much money on a monthly basis year one, but I'm going to be building this much more wealth every year by not selling, right? So they understand the investment potential. And then the question becomes, can they afford their next home if they don't sell this one? And the answer is 90+% of the people who call us can. They have other savings, or they've done a refinancing, or they come to us and we do the refinancing. So Knox has a financing function within our business. So we can either do a HELOC or a refi or a second mortgage, or sometimes we work with a partner of ours called HomeTap will actually buy a piece of the home from you. So they take like a stake in your home and give you some capital, and that becomes the down payment for the new home. The next thing we do is we go find a renter. So they're going to need a renter for that home, and with a lease in hand, that lease can be credited as income when they go and qualify for the mortgage on the next home they're going to buy. So banks will give you about 75 cents on the dollar credit. So you've got your W-2, maybe your significant other's W-2, and now you've got this lease, and that is your income picture for the bank. So you move out, we find a renter, we put the renter in there, and we take over all the responsibility for the home. All the work that it takes to be a landlord is on us. So we found the renter, we did the background checking, we did the legal and the leasing, the credit checking, etc. We do the move-ins and the move-outs. We collect the rent. We pay all the bills on the unit for the homeowner. So we actually manage a reserve account and do all of the bill pay. At the end of the year, we send the homeowner a 1099 because all the expenses and all the income has come through our system. So we easily generate the paperwork they need for their taxes. If the tenant has a problem, they call us. We have pre-negotiated very advantageous rates with maintenance companies. We don't mark them up. If there's a part or an appliance that needs to be replaced, we source that, or the vendor sources that. Again, no markup. And the homeowner continues to own the home. They get a check and a statement every quarter. They get the 1099 at the end of the year, and they own all the value without doing the work.
Really interesting. And you guys find like a long-term renter for the property. Am I correct? Or you go to like Airbnb and short-term rental type of tenants?
So right now we just do long-term. There will come a day when we will probably offer short-term, but not for a while.
And how do you guys use technology to differentiate yourselves from the typical property manager?
Well, before we get into technology for a second.
Sure.
So property management is part of what we do. So the typical property manager would take over the responsibilities once the tenant is in the home, and they would answer the phone if something went wrong. They'd send a repairman if something was broken. They might collect the rent. So that's bullet one. Bullet two, we also do the rentals. So we find the renter, we do the background checking, we do the showings, we do all that stuff. We do the legal, so we have the leases. You don't have to come up with your own leases. We've got that. We also do the insurance, because if you're moving out of a home, you have an insurance policy that's appropriate for the home you live in. When it's rented out as a rental property, you need a different insurance policy. So we find the right insurance policy.
Sure.
We do all the bill pay and accounting, like I mentioned. And then we have our financing function as well that a property manager wouldn't have access to. So in total, what we're really doing is looking at the home as a financial asset, maximizing performance versus just being the guys who take a phone call when something's broken or collect the rent. And that's what property managers.
Absolutely. No, I get the concept. It's really cool. So is your target market like busy professionals who don't have time to manage it on their own and so forth, or is there a different demographic?
There's three, and that's one of them. So the busy professional whose lifestyle has outgrown their home. That's sort of profile number one. Profile number two is actually folks who are at the other end. They're retiring. So let's just say you've owned a home for 30 or 40 years. You bought it for $100,000 or $200,000, and now it's worth $1 million or $2 million. And it's time to retire, and you want to turn into a cash flowing asset that helps you get or leverage tax advantages while avoiding costs like long-term capital gains taxes and transaction fees. Our platform is fantastic for that person, because when you're retired, you really want to be retired and not a landlord or property manager. And then the third clients we work with are folks who already have a property portfolio. Could be one rental unit, could be 10 rental units or more, but they don't want to manage it themselves anymore. And they just want to put it in the hands of a company that dots all the I's, crosses all the T's, sends them a check and a statement every quarter, and they don't have to think about it. We actually have people telling us, wow, this is great. I stopped buying property because I just didn't have any more capacity to manage it. I have a day job. Now that you guys are around, I might start buying property again.
And so let's talk about the tech a little bit. I mean, what do you guys have under the hood that's making all of this possible?
Sure. So the first and most fundamental thing we've built is a data model. So we can look at one home at a time or an entire market and decide, does this home make a good investment property, or does the average home in this market, does the average 1-bedroom or 2-bedroom or 3-bedroom home in this market make for a profitable rental, and how profitable? So, we've built these models and these indicators that allow us to compare, say, Boston to Houston, or the profitability of your home with the debt you have versus the guy down the street who maybe has lived there longer and refinanced 3 years ago, right? So we can talk to every single customer and help them understand the reality of their home. And then we can also look at an entire city and figure out which homes in that city should fit our program. And that actually drives our marketing. It also drives which markets we choose to go into next. Right now, we're just focused on the greater Boston area, but they'll probably, I know for a fact that in the not so distant future, we'll go into other metropolitan markets, and we'll be choosing those based on the data. So that's sort of bullet one.
Mm-hmm.
Bullet two is the amount of automation we've built into our process, especially around finances. When a rent, for example, we don't collect rent checks. We draw money from the tenant's bank account. That is automatically deposited into a bank account. We have a separate bank account for every customer. We don't commingle funds. All of the bills are paid on behalf of the homeowner automatically. All of our quarterly statements are automatic with 1099s. We've built a financial management system so that we can do all the bookkeeping for hundreds of thousands of homes in an automated fashion.
And lastly, how do you guys make money? How do you plan to make this a profitable business?
Sure. So we make money in three ways. First of all, we're an insurance brokerage. So we make money when we find that policy that the home needs because you're moving out. Number one. Number two, we're mortgage brokerage. So when we do some financing first, the small percentage of our clients who actually need it, we make money then. And then for all the services we've really been focused on, the property management, the rentals, we don't charge a rental fee, by the way. We don't charge 1 month's rent to the tenant or the landlord. We find a tenant. For the legal, for the bookkeeping, all that included, we charge 10%, but only of the money we collect. So we only make money when the owner makes money.
That's really interesting. Actually, as I was prepping for this interview, because I live in the Boston area as well, I actually got one of your cards in the mail, and I was like, oh, that's really cool, because it's always nice to see that a company I'm going to talk to is scaling, is aggressive, and so where are you guys at as far as you mentioned you're just in the Boston market? I mean, what's your kind of go-to-market plan for the rest of the country, or are you kind of going to stay regional, or what's your plan there?
Sure. So we're a very new startup. We launched our product less than 90 days ago. Our growth plan is to build the business in Boston for a while and get all of our key performance indicators locked down. So we should know what it costs us to acquire a customer here. We're already getting good data on this. What an average revenue per unit looks like, how long it takes us to rent a unit, all these indicators that would tell us the health of the operations in the business and the health of our business development function. Once we have that, we're going to then go to other markets and replicate the success we've had in Boston. And we'll likely pick markets that are relatively similar to Boston to start, because we want the numbers to be similar or better. And then we'll start expanding out from there. There are some markets where homes are more expensive to rent than Boston, like New York or San Francisco. And then there are markets that are dramatically less expensive to rent. And we'll probably stay away from those for a little while. Eventually,
Sure.
we'll grow into those other markets. But we're going to do it market by market. You know, you think about your other big real estate startups like Airbnb, for example, they did go market by market. If you think about any business that has some kind of a physical presence in a market, be it Uber or Lyft or Lime, the bicycle company, they all go market by market, and we'll do the same.
Yeah, totally. I mean, it is real estate is a local type of business, right? You still have vast differences between different markets, as you mentioned. Let's talk about the broader real estate space and the economy today, if you will, because you have a lot of experience in the space. I'm really interested to hear some of your opinions. What do you think are some of the most, market-moving, revolutionary technologies out there in general real estate / fintech or finance in general space?
I think the iBuyer space is an interesting one. There's a lot of people who are very willing to take a slightly lower offer to have a faster, easier transaction. It's obviously not going to be for everybody, but I do think you'll see that space holding on to a decent percentage of the market, and that's going to be here to stay. I really believe that. So that's a very new part of the market, and there's some companies doing quite well in that. I think the big economic transition that's going on is the companies that are removing transactional friction. In a lot of ways, we're doing this, but I'm not trying to talk about us here. If you look at the appification of many services, if you look at the ways that people are packaging what used to be complicated things to buy, it's a lot easier now to order something from Amazon that you used to have to go to Sears or Best Buy to examine and feel, right? So last year, in one of my rental properties, I needed a new washing machine. And lo and behold, I didn't even know they were doing this. I went online. I actually looked at Sears, which is used to be my go-to for appliances, and then Amazon had it for cheaper. And when I bought it with delivery, they said, "Do you want installation for $35?"
Mm-hmm.
I said, "Absolutely." Right? So it's not just the store where you buy your stuff; it's the store or the website where they've gone to the last mile. And by the way, it was Prime. It was a dishwasher on Amazon Prime. Right?
Wow. So free shipping and $35 installation.
Exactly. So I think it's you're seeing it much easier to buy the stuff you need and much easier to buy the services you need. That's going to come into home maintenance. That's very interesting. It's sort of companies that are revolutionizing the home warranty space. Home warranties are something that very few people actually bought, but now that you might be able to sign up for a subscription service where you just go on your app and say, my dishwasher stopped working. And somebody can punch in the code on my door and come fix it anytime between 10 and 2 because I will not be here. Right?
That's really awesome.
Yeah, that kind of thing is going to change the way home ownership works. And again, the revolution I see in that is the removal of transactional friction. And I think that's sort of what's changing life. It's sort of another thing is, my wife loves Instacart. That's how we buy groceries, probably once a week. That's one of the ways we buy groceries to feed our family. And she loves to sit there and order it, and it shows up, and that's making it easier to buy groceries. It's very similar. Yeah.
So now, like the shopping experience, even for groceries, has become more in front of the screen than actually in the aisle, right?
Right.
I talk about that with my wife sometimes as well. I mean, she still prefers to go to the store. I'm like, why don't you just order, Whole Foods and with Prime or whatever, Instacart. I mean, all those guys deliver. So yeah, that saves a ton of time. I'm also interested to learn what do you think about real estate as an asset class for consumers, right? I don't know what the numbers are, but I suspect there's a huge amount of equity kind of locked up, right? So someone has a home, they've been paying it down for years now, and the property appreciates. Now there's a chunk of equity there, and that's kind of sitting there. Some people take a HELOC, home equity line, and pull it out. Most people probably don't. And the reason I ask that, I'm kind of intrigued by this company called Figure, which does originations for home equity lines, and they're growing quite quickly. And I'm just wondering what your thoughts are on just the home as a vehicle to use for investments.
Yeah.
Mm-hmm.
So I actually think, and I haven't verified this data recently, but as far as I know, residential real estate is the largest asset class, period. So
I believe it is.
Yeah, I mean, it's certainly greater than all the other real estate asset classes, and it's bigger than your financial products class. I'm almost positive. So globally, it is the biggest asset class, and I think there's two incredibly interesting assets that people are not leveraging. You mentioned the first one. There are all sorts of people who have equity in their homes, and it's kind of just sitting there. If you believe that your investments should be optimized for rate of return. And that's, by the way, that's not right for everyone, right? If you're retired, you care less about rate of return than you do security and cash flow for a lot of people, right? But if you're, let's just say under the age of 55, or it's up to everybody what they want, optimizing for rate of return with a long-term outlook of 10 or 15 years seems to be the prudent advice for most people who have an investment portfolio. So if you've got a home that you bought 15 or 20 years ago, if you bought a home at the age of 30, and when you were having, you had a young family, and now you're 50, and your salary's gone up, and your cost of living have generally stayed the same, because your cost of capital is probably a fixed rate, a fixed monthly payment, whereas your taxes and your insurance have not gone up nearly as much as your income has. You have this opportunity. Your home has gone up in value. A lot of people just let it sit there. And I think that's a lost opportunity. The other asset that I think a lot of people don't use is their qualification for leverage. And it's amazing to me how many folks, again, same scenario. You bought a home 20 years ago at the age of 30. You're now 50. You have ample income to support other leverage. And I'm not talking about irresponsible debt. I'm not talking about you should have credit card debt or something like that. But if you could use that leverage to invest in, say, property or anything else that the world will allow you to leverage into that has a rate of return, that leverage obviously multiplies the rate of return. And I think in real estate, that's a missed opportunity by probably the majority of people.
Yeah, absolutely. Let's go back to something you said before about removing friction from various transactions. Do you think that's happening in real estate, and specifically, and I know you guys are kind of addressing one angle to that, but there's also so many other things that are kind of archaic, and I'm fairly new to the real estate space, so I've just been learning about it in the past year or so. And I think a lot of the stuff that's happening in real estate seems a little bit outdated, as you mentioned before as well. But for example, we have the process of doing appraisals, right? Appraisals have been done for many, many years. And the process is, you call an appraiser and they come out, or the bank calls an appraiser, they come out and they look at your home, they use a standard report, they fill it out, and then they give it to you or to somebody else. I mean, isn't that stuff that could be automated more or less with all this data that we have now, and Zillow with their Zestimate, and you guys maybe partially as well? I mean, is that stuff kind of going by the wayside, and are we moving to more of an automated model for all these transactions? And appraisals could help with buying and selling transactions, obviously.
Oh, that's a can of worms, my friend.
I knew it would be.
Appraisals are incredibly subjective. They're very hard to do truly accurately with software, because software doesn't know if you did a renovation last year. right? In those certain limited pieces of data, what's the home sale history? What's the assessed value by the city, which is always a wonky number? What year was it built? How much square footage does it have? How many beds and baths? That kind of data is available, but the quality of the space is unavailable. And that's critical, right? So I don't know that in-person appraisals will go away so long as an appraisal is a requirement for a mortgage under the Fannie and Freddie guidelines. That's not going to change. The question is, will the Fannie and Freddie guidelines evolve? Because a lot of your transactional friction in buying and selling a home comes from Fannie and Freddie. And really getting a mortgage is hard and it's laborious because of statutes that the banks have to follow, because the way our housing market works in the United States, the vast majority of mortgages are written by a bank, and then shortly thereafter, they are sold to Fannie and Freddie, who literally pays the bank 2% of the value of the home for having done that work. Or for not the value of the home, the value of the note. So if it's a $100,000 loan, the bank makes $2,000 for doing all that. And if there's a mortgage broker involved, the mortgage broker might get 1% of that, and the bank keeps the other 1%. If you look at what the bank is doing, the bank is writing a mortgage, and that mortgage is then being sold on a few weeks later to Fannie and Freddie, and Fannie and Freddie are paying the bank about 2% of the value of that mortgage. So if it's a $100,000 note, the bank keeps $2,000, and if there's a mortgage brokerage involved, the mortgage brokerage keeps about $1,000, keeps about 1% of that transaction. So until Fannie and Freddie change their requirements, we're not going to see appraisals going away anytime soon.
What do you see some of the things that could be improved with some of the technologies that are coming out today? For example, I know that blockchain, like the distributed ledger, there's a lot of real estate opportunities and a lot of companies looking at blockchain as far as, whether it's a ledger that they can record these transactions on, some kind of immutable a record for perhaps things like valuations, appraisals, et cetera, and not just blockchain. I mean, other technologies as well. I mean, what do you think are some of those things that could easily be fixed or could be improved with the technologies that are out there today?
So blockchain can very much make transactions simpler. The challenge with blockchain is it would replace the registry of deeds. So it would replace a function that's housed within the municipality, within the city or the town or the county. And that's hard to do. It's hard to get cities to adopt new technology. If you ever have been to a registry of deeds and seen the actual paperwork they keep on file, it's pretty amazing. It goes back years and years and years. So it's like a lot of transactions that involve the government. They're complicated because of that fundamental entity. And honestly, to think on a macroeconomic scale here for a second, it's really important that the government is tracking who owns what, and people really can own property. In countries where property ownership isn't well tracked, the economies do not function nearly as well. It's one of the most fundamental building blocks of a successful economy is effective property rights. So you don't really want that system to be, too fluid, but you would like it to be easy to transact with. So if you could have something that's stable and easy to transact with, you'd really have a winner. And if we could evolve that towards the blockchain, it would be, dramatically easier to buy and sell a home. It would also be easier to buy and sell any real estate and even securitize that real estate. So instead of it being one asset owned by one entity, you could break it up into shares, and that could be done on the blockchain really easily. And then those assets could be traded more fluidly, and that would be good for economics in all sorts of ways. So enormous number of opportunities if we can ever get there.
Totally. I completely agree. I think we're sitting at a cusp of an inflection point perhaps with fintech, all these technologies, blockchain and others, and just improvements in the way that finance in general is done. And I think it's a great thing for everyone. I mean, it's enabling people to get credit they didn't have before. It's enabling access to investing maybe higher yield investments that weren't really available before. I mean, it's enabling a whole bunch of other stuff. So really excited to watch this space mature. And so, yeah, David, thank you so much for joining me today. It's been a pleasure speaking with you.
Hey, this has been great. Thank you so much for having me on.
Thank you. Take care.
Take care.